Satya Nadella had once said that road to IPO is paved with strategic choices, relentless execution, and the ability to think beyond the listing day. And I think today we have a panel of diverse industry leaders who have not just witnessed but shaped and guided many companies through this transformational journey. So let's ring the bell on this session and please join me in welcoming our esteemed moderator for this engaging discussion, Mr. Mandar Barahate, Global Head of Valuation and Portfolio Monitoring, Alpha Wave Global. Mandar, being a seasoned expert in valuation, alternative investments, M&A, and transactions, is a perfect moderator for this session. Please join me in welcoming Mr. Mandar.
It's an absolute pleasure to welcome you all for this panel, which is about unraveling the IPO quest and the discussion on the dynamics related to that. Please allow me to introduce my panelists here. Our first panelist for this panel is Amit Junjunwala. Amit is a CFO at Accel India, overseeing fund and portfolio finance, due diligence, tax-related aspects. Amit is a very seasoned professional in the industry, and he's a mentor figure to many startups and early-stage companies, helping them to wade through various financial reporting, taxation-related challenges. During his time at Accel, the firm has seen major IPOs happening in the public markets, BlackBuck and Swiggy to name a few. So Amit, please come to the stage. A very warm welcome to you.
Thank you.
Our next panelist is Satya. Satya is the CFO at BlackBuck. He has been instrumental in transforming the company from private to public accountability. Satya oversees financials, tax, legal, secretarial, all those streams at BlackBuck. Just for the knowledge of the audience, BlackBuck, which is the largest digital trucking platform in India, had initiated its debut on NSE and BSE in November 24. And known with the legal name of Zinca Logistics Solution Limited. Satya, please join us for this discussion. Thank you for taking out time. Our next panelist is Abhilash Padiwal. Abhilash is the Director of Investment Banking at Bank of America Merrill Lynch. He focuses on consumer internet sector. Along with his focus on investment banking, he has experience spanning across public market advisories, corporate strategy, corporate development, leadership management, and many other fields in his prior avatars. In his current role, he has worked on multiple tech IPOs emerging out of Bangalore. Please join me to welcome Abhilash to the podium. So warm welcome to the entire panel here. And we are here to discuss about the IPO landscape, IPO market. And given the activity that we have seen in IPO market during 2024, one would ask, why wouldn't we take up this topic in Private Markets Conference, right? Because it's been a phenomenal year, 2024. There's been a mention about this activity across the domains. If you look at the India Economic Survey, which was recently launched by Government of India, citing an EY report, India topped the IPO listing globally with 327 IPOs in 2024. The deal volume was second globally. Right, so it's a phenomenal performance of the market during 2024. The Association of Investment Bankers of India project that India is likely to see around 1,000 IPOs coming in the next fiscal years. So that's FY25, FY26. what stands out is not just the deal activity or the deal volume. It's actually the breadth and the depth of the market, right? Because what we have seen is that these IPOs have spanned across sectors, which is unlike major markets like US, where the IPO activity has been fairly sector specific. We are seeing many multinational corporations either listing or planning to list their subsidiaries and unlock value in India, which was not a scenario earlier. There's been also a big pipeline of reverse flipping startups, right, where a lot of companies are changing their domicile back to India to list on the Indian bourses. Now, none of this would have been possible without the tireless effort of the stakeholders, and there are many stakeholders in the entire ecosystem, starting from SEBI, merchant bankers, stock exchanges, registrars, legal advisors, auditors, and many more. We need to have a very comprehensive discussion, including all of them, if we want to get a full perspective here. And their contributions are very instrumental in shaping the entire ecosystem. But given the context of the conference here, which is private markets, we thought it is pertinent to bring in three key perspectives here. So we have a private investor on the panel. We have a CFO of a company who has seen through the entire IPO journey, and we have an investment banker or lead manager who plays critical role in getting these companies through finish line, and new age sectors or the tech sectors, their involvement is even needed, post the IPO for a longer period of time. As a caveat, as part of this panel, we are not going to discuss regulations or procedures or compliance. That's typically available as educational guidance. What we intend to discuss are the real life experiences and challenges across this entire process. So we'll explore this journey from initial IPO discussion. What are the factors to consider IPO as an exit option? Where companies, weigh in various factors to decide that exit path, to strategy and planning during the entire IPO process, and then moving to the IPO process, finally closing the discussion with the post-IPO life. That's going to be the flow of our discussion today. So with that, let's get started. A lot of context has already been built, and let's dive into the discussion with our first segment, which is the seeding thoughts for IPO. And the first question is to Amit. Amit, with the current situation in private markets, where the companies are in various stages, can you discuss some of the potential exit options that the companies have, and which are various factors that should be weighed in to consider IPO as an exit possibility?
Sure. So, see, when we, as early stage investor, come into a company, there is always a timeline for exit, right? So it's not like it's a permanent capital, because this capital comes from a set of investors who have come in with a time horizon. So definitely there is an exit which has to be provided to these investors, right? So what are the typical exit scenarios for a private investor, right? So you can look at M&A, right? Like M&As are almost, I would say, the most value creation from a company perspective. If you have to look at liquidity, I think they are the best value transactions, very quick to execute, and cash is on the table on day one, right? So I would expect that to be the most lucrative option for a private investor. But can you really time it? Can you really be sure that M&A will happen? And also, when a founder is getting into M&A, there are different feelings, because how combined entity will work, will this business have a priority, will they get the right capital allocation, all that becomes very critical, right? So while it provides good amount of liquidity, immediate liquidity, you don't have to get into a grill of lot of day-to-day or quarterly or monthly or whatever reportings. But at the same time, it can have a negative on the founder side, whether the business will actually get to the final full potential, because the management change, integrations, all those can have a challenge on the founder. Right? So while that is where you have to balance whether M&A is the right opportunity for a company. But when you look at a company which is where you have two players going head on head, and you know this market cannot have two players, then maybe that is the time when you will look at M&A, right? Like just consolidate the two and become a better one, rather than burning money on both sides and not getting any output, right? So that's the kind of scenario where you will see M&A is the right opportunity. Second, for a early stage investor, there's always a possibility of giving it back to a larger investor, like a PE exit, or exit to another investor who is coming at a late stage with a plan to IPO. You can either do full exit or you can do part exit. You can take a call whether you want to ride on for the long time, or you just want to get done with it and sell it to an investor who is more sophisticated, able to take company public, and you just get out, right, at the right time. So that can be another, but there again you have to have alignment with the founder promoting team that they are able to drive the business with the same kind of a rigor, and investor doesn't come on the way, right? Like it has to be a right balance. So that is something which is again very popular, and many investors exit to a private equity or a large investor. Then we think of other options, I think, which is very rare, is a buyback by the founders, where company employees, founders, they will come together and give an exit to investor. Those typically happen in a profit-making company where there are a lot of cash reserves, where you are like a minority investor and founders have enough money to just buy you out, right? But we have not seen those exits, like maybe one or two in a overall 15-20 years life cycle of private equity investment, right? So what is the obvious choice is IPO, right? And why I say obvious choice is where you can work towards it, you can plan it, you can execute it if everything else falls in place. And what is everything else? Maybe you are operating in a market which is very which has a large TAM, where there are a lot of growth opportunities. You have a compelling story. You have a good team, good leadership team, which can actually drive the company, right? So, and the founders are in a long haul. They want to build a legacy. So those are the parameters which you will consider before taking a company public, right? You'll also look at what are the market dynamics. Is it something where investor has a lot of interest? Do they like this segment? Are there other players where you can do benchmarking? And all that will play out in terms of deciding whether you can go public, right? So I don't think there is a right answer, but yeah, everything is dependent on what works for investors, founders, business, and everyone put together takes that call. Like, what is the right exit strategy?
Oh yeah, no, that's a very good context. And maybe one of the aspect to that analysis is also to see what is an appetite when we are doing the portfolio strategy or exit strategy.
Yeah.
So the next question is to both of you. How does the appetite look for companies to go for an IPO, maybe currently or maybe with a span of 4 to 5 years in future, right? Because a lot of companies in mid stage or growth stage may look at an IPO milestone at that point of time. So any thoughts on the IPO appetite as of now for these companies?
Yeah, no, I think, we've actually seen 2 waves of IPO here in India, more from a startup perspective. The 1.0 wave, which we basically saw in 2021, and then the 2.0 wave that we are actually seeing right now.
So what 1.0 wave, sorry to interject, the 1.0 wave is basically the Zomato, Nykaa, Paytms, those are the IPOs.
Right. And then we've had a spate of new age tech IPOs in the market last year, the Swiggies of the world, Ola Electric, First Cry. And then there are a bunch of companies that have actually now filed their prospectus or in the process of filing their prospectus. So I think from an appetite perspective, or let's say from a supply side perspective, I think there's going to be significant demand out there, right? We have maybe, close to like 150 unicorns in India. We've learned a lot from, the performance of the companies, some of the key takeaways from companies that went public in 1.2. And I think, there's a lot of readiness within the companies in terms of process, in terms of, public market readiness, etc. Right? So I think you're going to see a lot of supply in the coming days. You talked about 1,000 IPOs. I think in terms of volume, just the valuation of Indian new age tech is close to like anywhere between $300 to $400 billion, right? So even 15% of that coming into the market is close to like $50 billion of supply. And the good thing is, these companies have performed well. There's a lot of investor appetite, not just in India, but even outside of India. Some of these business models are very bespoke to India, but they basically, sort of give you an opportunity to invest into, the consumer sentiment, invest into, the real Bharat businesses, right? So I think both from an investor perspective, from a supply perspective, etc., there's going to be, like significant supply out there.
Yeah, so just to add to that, I think appetite-wise, definitely there's appetite. The amount of capital which is coming in the market every month, we know all SIPs, all of our money. And so that money is trying to find ways into a new set of investments, right? Like there are traditional businesses, there are new age businesses. Now traditional businesses are feeling the heat, right? Like a quick commerce is giving a tough competition to, forget about Kirana, even a large departmental store, right? So when they are rethinking their strategies, how do they do that, right? And suddenly you see a place where you have 10 players fighting for the same wallet share. And if you really look closely, nothing has changed. It's the same consumer which was buying from, say, a departmental store is now buying from a quick commerce, right? So it's not an expansion of market, but at the same time, convenience has a price. So instead of the same product which you are buying at X, you are buying at Y, right? Or X plus something. So from a capital flow perspective, there is enough capital coming in to absorb these IPOs. So there is interest. VCs or private investors are also mindful that these are more sustainable business rather than you are just trying to dump it and exit. It is more thought through process where you know that there is a lot of growth left, and that is important, right? You want to just exit a company on a public market without a future, right? So their sustainable revenue, profitable growth, all that is becoming a challenge, becoming a prerequisite, and that's where people are also investing time, and they are timing it well, right? And ultimately, when we look at IPO as private investor, we are not looking at a short-term game, because even after listing, there is a good 3-4 year, 5-year journey before you completely switch the cap table. And you want people who are long-term, people who are going to take the company to the next level to come in, right?
Yeah.
And those are, in current context, from a domestic side, mutual funds, and from a foreign side, you always have foreign investors like, say, a pension fund or a Temasek kind of a government sovereign fund. So those are the people you want on the cap table, right? They come, they stay, and they will stay forever for the long-term growth journey. So the management team can focus on execution, and these investors are there to compound, right? So that way there is a lot of appetite.
Yeah, so leaving value on the table.
Yes.
And that's one of the themes that's coming out. The other side of this summit is one question about, as an investor at an early stage, when the IPO decision is not even made, how do you prep the companies to look at the milestone, and how do you plan out the journey at that point of time?
See, I think we invest too early, right? So definitely on day one, you don't know which company will go IPO. But at least off late, I've been seeing this discussion in the IC that you want a structure, you want a company in a set up in a manner that eventually it can go IPO, right? Even if that's not the end game, but there should be a path to that game, right? Most of the preparation for an IPO, or I would say those things come up like 2-3 years before you want to really hit the market. Some of the things like a mock audit committee, right? Like that is something which we like a lot, do a lot, where once you are in the public market, you are answerable. It's not like in a private market, your numbers are not that important. Even if you miss one quarter, you're okay. But in public market, that's not the way it works, right? So how you are able to drive a governance which is top the class, where you have accountability, audit committees which are ready to challenge you on your projections, numbers. Also, as a private investor, you are able to guide the company in building those models, financial projections, which they can deliver for the next 3 to 5 years, and challenge it, stress test it, look at what can change, how can market impact those kind of projections, right? So somewhere giving the company a kind of journey where what will come in the public market, some bit of that you prepare them, be it on the governance side through mock audit committee, be it on like doing some bit of every quarter the CEO, CFO has to go and speak in the public market and really be answerable to a lot of analysts, right? Like, how do you face that? Organizing sessions for companies with public market investors in a more casual form where they can make a pitch, they can get it more kind of very, very comprehensive, sophisticated and targeted, where storytelling comes out very clearly, right? Because when you go for roadshows, when you start doing those meetings, it's all about what you tell to those guys, right? Like, so your story has to be very clear, and that is what you can do at the background with the private investor doing those mock tests, right? And after that also, I think investment in IR team is very important. With a private investor, IR team is technically a founder and CFO led. But when it comes to public market, making sure that after listing, you continue that journey, have that continuous dialogue with the investor, because ultimately, once you hit the market, there is a big supply which will come in the market. So how do you manage that supply? How do you get there? I think some of these things are important.
Yeah, we will touch upon those points in more detail in the latter segment. But I think the bottom line is mocks. Mocks are important.
Yes.
Whether it's CFA exam, MBA exam, or the IPO preparations, right?
Yes.
So that's a takeaway from that. Satya, apologies. I'm coming to you now. But so from an internal point of view, some of these questions, right, before taking that decision, can you give us a flavor in terms of, from a corporate strategy point of view, how these questions are dealt with, and what are some of the situations that emerge at that point of time?
Yeah, so if you think about IPO, what does it provide for a company, right? One, definitely provides access to capital. I think that's one of the most important things. Second, it also gives the ability to hire talent, right? So because it gives that brand visibility, people want to be a part of a listed company. It also helps convert that paper money of ESOP into something which is more real. Third is, so in the private markets, if you go and have a conversation for an acquisition or an M&A, I think the conversations are more cash-led. I think because the stock becomes liquid, you have the ability to do more inorganic acquisitions, right? So these are the things that it opens up. Flip it to like a private market. I think if you have an opportunity where heads down, away from the public glare, work on something which can build a large LTV in the future, right? So I think then private markets are good. So broadly, there is benefits of both. But I think once you see strong PMF on, let's say, 3 or 4 areas that you're working on, there's broad predictability in terms of revenues, profitability, all of that. And you need, let's say, there's an exit that's required or a capital that is required. I think in those scenarios, you turn to IPO, and then you start planning towards an IPO, right? So I think that's broadly the context in which we think whether, let's say, private, public, how does it work? I think, but like Amit said, quarter on quarter becomes very, very critical from a public point of view, and hence predictability in revenue, product market fits, your pilots being a lot more smaller. It might be deeper, but a lot more smaller rather than really expansive. I think those are the factors that you consider before kind of going for an IPO broadly from a company point of view.
Yeah, no, very valid points. And you know, this I think dovetails into the next question. When the IPO, the strategy is decided, what are the changes in the org that happens? How does, say, for example, finance function org, right? How do you plan for that? How do you start building that rigor in the organizational process? So if you can share a few thoughts on that.
Yeah, so I think a lot of times it's time crunch, right? Because you take a decision for an IPO. I think internally the preparation is more around, like I mentioned, getting the businesses in place, getting the revenues and profitability and internal team organized, all of that. But a lot of IPO is also market dynamics. It's also outside in led. So you take a call, and broadly, I think a good 18-month horizon is a decent time to prepare for an IPO. From an org point of view, you have to take a call whether to build internal flex or external flex, right? So you need a lawyer definitely on a retainer, you need a secretarial firm, you need an audit assistant, a firm that helps you with audits. So I think broadly from an org point of view, the decision is whether to build it internally, whether to build it externally. What I've seen, at least across peer groups, etc., is external is more flexible. You can always expand on bandwidth at any point of time, right? So I think building that entire ecosystem that helps across audit, secretarial, legal, tax, advisors across, I think building that flex across the ecosystem is what helps kind of prepare for an IPO from just an org point of view before the entire preparation really starts. This is like a cue for the prep to start.
Got it. No, that's very insightful. And Amit, on the same topic, right? When the company is preparing internally, I wanted to get your perspectives on the governance focus. You touched upon that, but if you can go a little deeper into that, because I think that is one of the key areas, right, to focus. So, from a fund perspective or an investor perspective, how do you help the companies to top up the game on governance front? I know there can't be a checklist, but can there be a framework or can there be a methodology around that? I mean, if you can go a little deeper on that.
Yeah, so I think from a governance perspective, some of the things which comes in my mind is definitely getting the C-suite in place, right? So you can't be going to an IPO like without a CFO, right? Or without having clearly identified business leaders, right? Like you have to build for enough redundancy. You have to build, like, you have to really be having an org structure which is sustainable, resilient, and there are enough people within the system where things can fall on each other, right? Second is independent board, right? Like, how do you build that independent board? When do you bring people? Like, for a private company to deal with independent directors is not easy. It is difficult choice because the board meetings in a private environment are more business led. They don't have a lot of formalities. Things are little in a way, I would say, shortcut. But when you go for a structured board where you start adding internal independent directors, it becomes little onerous, right? So how do you prepare for that? And that's where that mock audit committee is something which we do with a lot of companies where you have some of the investor representative coming together and forming a committee where all the function heads, finance heads, they are all present. Internal audit is a good tool, right? Like we focus a lot on that, putting companies on an internal audit framework where there is a quarterly or a half-yearly rigor, and internal auditors have access to this committee and they are able to come and present the findings, and that puts a pressure, right? Like, where are the gaps? Where do you want to focus and fix the processes so that from a governance perspective, you are up to mark, right? As Satya said, there is always a crunch in terms of how soon you have to present the number. Earlier, while you agree MIS schedule, even if you are late by a few days, it doesn't matter. But now you have to publish a result in 45 days. And 45 days is a statutory threshold, but if you are in an environment where there are 5 companies, you don't want to be the last, right? Because you know the narrative, right? Like, if there are 3 players, if 2 players have given slightly bad numbers, you know your stock will also get a thrashing if you're the last, right? So somewhere that predictability and putting together that process where you have a good financial reporting process where you are able to close your number with certainty is important. So that's where the entire stat audit and other processes comes into place. How can you work with stat auditor to make sure that you identify where are the gaps? Are there systems which are missing where you need to invest and get those system in place? A lot of these companies are heavy on number of transactions or volume of transactions, right? So you really need sophisticated IT system. And what we have seen in a private world is when an auditor comes in and they want to rely on these systems, invariably they are not able to rely because general IT controls don't pass, right? So how do you get the right person in place to fix those systems so that auditor can rely on the audit system rather than doing things manually, right? Because when you have crunch, you also have crunch in terms of the number of days you can provide to the auditor, right? So if everything has to fall in place, some of this building block has to be there, right? And then at the end, from a like, how do you have a sharper view on P&L, unit economics, part to profitability if you're not already profitable, what are the various pilots or new projects you want to take up in future, giving flexibility on that, like how do you look at it? Some of these things is what
Areas get covered.
what is important.
So very pertinent points. Yeah, I think for any company going for an IPO, I think these are very important areas to look into. Now, let's shift focus towards the external side, right? So as an investment banker, how do you see this process from start to finish when the IPO decision is being made? We have still not entered the discussion about or within the IPO process, and we'll discuss the IR part later on.
Sure.
But how do you, if you can explain to audience the role of investment banker from start to this point?
Yeah, so maybe, like I'll just sort of dovetail it to where Amit stopped,
Yeah.
right? The process of prep probably will start like 18 to 24 months earlier. Some of the points that Amit made about governance, controls, etc. are very important. One key point is, like you'll need to sort of have a very detailed business model which sort of will transition into the public markets, right? So you need to sort of stress test it in the private market or let's say when you're private, right? Every quarter, if you're meeting your numbers, etc. The second work that is important to do is also on KPIs because it's a very important topic today. Understand what are your important 10, 15 KPIs. How do you basically, which systems do you basically leverage them? Can you audit them? If you cannot, how do you establish that audit trail, etc. Right? That's one. The second most important thing is, as Amit and Satya both said, one is constitution of the private board and as well as key leaders. The private board, the private board members become that much more important because you just don't want to sort of, nominate them just 6 months earlier. Probably you nominate them 18 months or at least 12 months before your IPO. Because today there is a lot of onus on, your private board members. Because there is a lot of things riding on them, right, in terms of sign-offs, etc. Yeah. It is also important for them to sort of have that context on the business. Their constitution, again, it's very important. You basically bring in a private board member who's very good in audit. Then you bring a private board member who's sort of an industry expert. Bring in a private board member who's good with government relations, etc. Right? So all of these things sort of take time to, sort of settle down. So I would say, these are the top 3 things. But let's say from the day of kickoff till the IPO, while there are several tactical things that you basically do in terms of preparation of your DRHP, the business section, non-business section, the 2 most important prep areas are, in your DRHP, there is something called the industry section. Especially from an India perspective, most of these startups are, very unique, right? Like, for example, BlackBuck is a very unique business. You may not find that in any part of the world, very bespoke for India. You see a spate of B2B companies sort of IPOing this year. Their business models are very unique. So I think the industry report becomes that much more important. So you need to sort of work with some of your consultants to think through the industry thesis, drivers, etc. Right? So that's one. 2, I think, as Amit said, it's important to start developing your storyline. What are the key drivers for the company? What are the key drivers for the industry? Drivers of unit economics? How do you position this? What is the TAM? What are the adjacencies and all of that? And then finally, prep for the roadshow itself, right? In terms of what are the constituent investors? Which geographies would you want to attack? Which funds would you want to speak to? Because there are several dynamics in that. If you're a tech platform, then do you basically talk to tech focus investors? Is this business well understood, let's say, in the UK and Southeast Asia? Are there parallels in the US? So do you basically, sort of over-index in the US and over-index on funds which would have been, invested in the same businesses, etc. Right? So I think that's basically the 3rd or 4th bucket.
Yeah. And touching upon market readiness, going into the process, I think, those elements have to be kept on radar, right? So how do you assess market readiness? I know there cannot be a science here, but what is generally the accepted methodology or a procedure around this aspect?
Yeah, I mean, I think there's no specific science, but from a framework perspective, I would say, like what Amit said previously, right? If you have a business and then, I think from 1.0 to 2.0, what we've basically seen is, 1.0 during those IPOs, I think investors were more focused on growth. So they over-indexed on growth, right? In 2.0, the focus has now moved towards long-term sustainability, profitability, etc., right? So at least if you ask me the framework today, is if your business has a core business which is profitable, good unit economics, right? Then I think you're sort of ready for the markets. What's also important is to sort of think about various horizons of your business, right? So there's a core business which is profitable, which is cash generating, and then you basically talk about your near-term bets. Hey, listen, we are basically investing in these 4 areas. I think these are large TAM segments. These segments will sort of contribute to a large, revenue proportion 3-4 years down the line. And this is the capital that I'm willing to sort of commit, right? If you basically have that visibility and maturity at the business, then you should do, right? And then the third horizon of the business is, hey, listen, these are option values, but these can be large outcomes for the business, right? And I'm sort of investing, let's say, $40-50 million into this, right? So your ability to sort of look at the business from that lens, I think is a very important thing, right? That's more from an internal perspective. And of course, all the other things, right? Your senior management is in place, your board is in place. And then, if there are any important, corporate restructurings, etc., right? You're through that. Very important thing that sometimes we overlook is, if you've had a large M&A just before the IPO, right? Have you fully integrated? Are you able to sort of articulate the synergies, etc., right? It's very important. You don't want to sort of just acquire a company, go into IPO, and then in the public market start integrating, etc., right? So you would want to go through all the volatility even before you IPO, right? I think these are some of the, themes that you would sort of
host of factors.
Yes.
Host of factors you can do. So you touched upon roadshow, and maybe, we with that we jump into our next segment, which is around the pricing and the roadshows and allocation. So they're coming back to you. If you can give a flavor around the roadshows, right? What is that all about, and how is that process managed? Maybe briefly, that'd be really helpful, and then maybe we can touch upon the allocation process.
Yeah. So I think before we go to roadshows, just in terms of preparation, right, I think there are 3 or 4 areas where a lot of intense work is required. I think one, like both Amit and Abhilash mentioned, I think having the board in place is super critical. Second is also capital structure, right? So there cannot be any outstanding rights on capital post the DRHP date. So solving for all your partly paid up shares, your right to subscribes, your incentives to founders, setting all of that in place is important. Third is also, if you think about intermediaries, there are a bunch of intermediaries. You have a bunch of lawyers, you have a bunch of auditors, both, let's say, independent chartered accountants, your statutory auditors, then your bankers. I think getting all those intermediaries in place, that's critical. Fourth is obviously financials, ensuring quarterization, because as soon as you become public, you start reporting quarters. So the previous quarter, restatement of the previous 3 years. If you're not on Ind AS, moving to Ind AS, I think a lot happens around the financials, which is very critical. And obviously the business section, as Abhilash alluded to, actually setting up the story right in the entire business section. I think everything else is more about rigor, is more about getting the job done, putting in those hours. But in terms of business section, I think really thinking through the storyline is what is important. Right. So through the business section is how the roadshows start off. So from a roadshow point of view, the most critical thing first is the story, right? So what is your TAM? What is your current penetration? What are your current revenues? What's profitability? What is the core business? What is working well for you? What are the optionalities in the business, right? So putting all of that together as part of a discussion deck, I think that's critical before you start the roadshow. Once all of that is set, I was just telling them that roadshow is broadly like a dancing troupe, right? Performing 4 or 5 times a day for like a period of 40 days. So it's about 4 to 5 meetings, probably overall about 150 meetings set up by bankers, right? So that's broadly where you, the story is all aligned. It's an instant repeat across 120 meetings, right? But some of the critical things to think about in the roadshow is one, I think from a company point of view, we always had a list of DIIs, FIIs to ensure significant coverage, people who have invested in similar companies, similar thematics. I think that's important to have to ensure that the coverage is good. Second is probably identifying the right analyst within a particular fund, identifying the right sector person within the fund. I think that's super critical. Third is having a feedback from a company point of view, so that we can kind of give that to bankers and say, hey, post the meeting, these are probably the 40 shortlists who we should spend more time with because they understood the story, they believed in the business, right? So giving that initial cue or feedback to bankers, I think is critical. And fourth, what we've seen, which actually a little bit surprised us also, is that the public market investors spend probably 3 or 4 days in kind of due diligencing, but they go very deep, right? So having flex bandwidth in the management for any follow-ups from investors to really help them get across the line in probably a 3 or 4 day time frame. I think these are some of the things that are very critical during the whole roadshow process. From an allocation point of view, I think it's more art than science, right? A lot, I think probably 2 or 3 general frameworks that are used is to have a significant breadth of investors, because I think the allocation is only limited to the anchor book. The main book is more open, right? If you have significant breadth in the anchor, it provides a good hook for them to come into the main book. I think that's one of the things that is critical. Second is having good names on the anchor, because the anchor is published prior to the main issue. So it inspires confidence in public, it inspires confidence in retail, all of that. I think it's important. Third is probably taking a view on long-only funds, I think is something which everybody kind of suggests. Now people take long-term view. I think the running joke in the company is that everybody says long-term, and in one of the meetings somebody said, I take long-term view on things, we invest with a 3 to 6 month horizon, right? So what is long-term in public markets is pretty tricky, but having a view on funds which are like long-term. And I think just ensuring fairness across banks, across company, across investors to have a stable cap table. I think that's the art around the allocation process.
No, I think that's very insightful. I mean, some of these points, generally don't come out in popular media or other things. So that's very good to hear the actual experiences of the actual process around this. Now, maybe let's shift gears to our last segment, which is, life post-IPO. And maybe you have the most to contribute here, because you have lived through that or you're living through that phase, right? So what would be some strategies to maintain investor confidence? Some of the things like material event disclosures, balance of information sharing in public domain. How do you achieve that? If you can share some light, and then maybe we can jump to the IR section.
Yeah, so we are 3-month-old babies in the public market space, right? So I think the couple of things that you touched upon, I think, are important. One, at the end of the day, the business has to deliver results, right? So from a finance, governance, compliance function, we are just reporting the results at the end of the day. So the business has to do well. With that caveat, I think a couple of things that we have seen is required is training internally. I think how the entire teams work in a private space versus a public space is very different. Like, for example, a particular vertical business head knows only his revenue today. Earlier, probably he knew the revenue of the entire company, right? So I think good training in terms of what is UPSI, what can be said, what cannot be said, having a good STD in place, training the insiders, having restrictions on when trading window closes, what is insider trading. I think having all of that trainings in place is very critical. Hence the secretarial compliance becomes very important. Second thing is cross-functional communication has to be extremely robust, right? So for example, if a tax guy in the team receives a notice for X rupees, it has to be communicated to the stock exchange within 24 hours, right? So which means the communication has to be so robust that he informs the secretary at a right point of time, secretary informs the audit committee, and then you file with the exchanges, right? I think cross-functional communication across business, across various streams with the secretarial team is super important. I think those are a couple of things that we have seen. And obviously, in terms of sharing data, I don't know if it's a good thing or a bad thing, but now everything is in public domain, right? So really balancing out what is it that we disclose as part of material disclosures, what is it that we disclose in earnings call is important. And probably in the private space, you meet an investor, he asks a particular question, you are anyway reviewing it internally, you go out with an answer, right? But in the public space, if it's not available in the public domain, then you cannot really answer. So I think having that balance is critical. And also it makes it easy. These are the details that are in the public domain, so it's available for everybody. So that's our experience over the last 3-4 months.
Great. And Abhilash, shifting to the IR function, right? If you can share some thoughts as to what are the best practices around that, and how practically to deal with that?
Yeah, so I think IR function, as Amit said, right? Like in the private world, the IR is typically the CFO and the founder, but a lot has actually changed in the past few years, and I think is important for a lot of you all as CFAs, right? We start to, our advice to companies is to basically build IR functions like 12 months before the company goes public, because the IR head goes through that rigor and goes through that entire privates to public sort of market journey, and he has full context in terms of most of the investor interactions. In the public world, I think the most important thing for the IR head is to understand that at least 25%, if not even 50% of the cap table of the company would be recycled in the first 3 years, right? So if you're valued at $1 billion, so there's going to be $500 million of supply, and it is in your interest and it is your responsibility to ensure that there is a smooth transition of that $500 million, right? How do you do that? I think it's important for you to be very rigorous and see that, hey, listen, who are the top 25 long-only crossover investors or long-only investors? Who are those top 10 domestic institutional investors who've shown keenness in the stock? Which tech investor or which vertical tech investor that I would sort of target, right? So you should have that in your mind, saying, hey, listen, these are the top 25 investors and this is the top 10 supply, right? And your ability to sort of match that. That's one part of the job. But I think a very important part and an equally important part is also basically analyst engagement, right? Is to how to sort of build that coverage portfolio for your company. Very important to sort of, timely communicate with analysts, ensure that the right messaging is actually reaching out to them, the right articulation of the business is reaching out to them, you're timely communicating stuff, etc. Right? So I think it is important. Some of I would probably categorize them into 3 parts. One is basically managing the demand supply dynamics. 2, basically building that roster of investors, my top 25, 30 investor, and understanding what each of them basically think about the business, and then build this portfolio of coverage across analysts, right?
Brilliant. I think that covers the agenda point we had, and I think there's a lot to digest from this discussion, right? There's a lot of points. So thank you so much for this really comprehensive discussion. Now I believe we have a bunch of audience questions, so maybe we'll go through those. The first question that I saw here was on reverse flipping, and without giving specifics, if you can share some details about the process and the scenario that is emerging, maybe the scale of the opportunity. What do you want on this?
Sure. So I think what are the top equity markets? If you look at it, it's US and India. I think beyond that, we don't have access to a capital market, right? So being an Indian company or Indian origin company, even if you are a cross-border targeting global businesses, ultimately your option to list is either India and US. US, while it is very lucrative in terms of valuation, understanding, depth of investor, but there are like good gating criteria also, if you can call it, right? Like at least what we felt and kind of understood is at least $1 billion of revenue, not valuation, is what is required to get into a meaningfully in the US market, right? So unless you are at that scale and still you have a growth left, which is like at least 20 to 40% year on year, you should not look at US market, right? So $1 billion scale, and after that good foreseeable growth, and either a category leader or in a category which is like really, really active, because US market is all about sentiments and what is working at that point in time. Other companies don't get any attention, right? And unless you are part of a index fund, it doesn't get you any passive flows. In US, the mutual fund is not as actively managed as in India. Most of the funds are linked to index, and everyone just invest if you are part of the index, right? So you will not get passive allocation unless you are part of an index. So, and getting there are criteria. There is always like top 200, top 2000. There are different indexes, different kind of parameters to get into an index. So that's why we also felt that for a company coming out of India, going and listing in US, maybe a little long shot. And that's where you want to have optionality to come to India at any point of time, right? Now, from a process perspective, US is a little peculiar, but other geos like Singapore is pretty straightforward now because some companies have tried and they've got to a positive answer. Typically, it's a cross-border merger is what comes as a neutral option because you get all the benefits of holding period, your cost base, entire story is intact because you're not rebuilding a cap table. You're just trying to move HQ from location A to location B. And from an India perspective, if you're a business which was always India-centric but was set up overseas just for random reasons, then anyways, there is obvious choice to come to India. But even from a global business, which are like SaaS or people who are only focused on like high-tech global business, even for them to come to India, there is enough value because when they look at it from an India market, export-oriented theme is always something which is liked by the investors in India, right? So there is ways to commit and there are reasons to commit and come to India, right? So merger is the most optimum route.
Yeah. Okay, one more question is, since we are doing this conference in Bangalore, and we all love Namma Bengaluru, right? You have all gone through this process, or this has been one of the major workflows as part of your portfolios. What can be done in Bangalore to, accelerate this ecosystem, various stakeholders and all? Any thoughts that you have that you can share here?
Sure.
And it can be creative, right? I mean, it doesn't need to be comparative, but it can be a creative thought process. Yeah.
No, I think one distinct difference that I've seen here is that we've seen companies of all size sort of go public here in Bangalore, right? Large ones, as well as companies closer to like 1,000 crore market cap, which probably we've not seen that much in other cities. So I think there's a lot to learn from each of this, right? I mean, like Satya basically talked about his experience of taking companies to public. So, for some of these smaller companies, they may not have the advantage of, sort of a formal, engagement like this, right? So I think, more interactions like this in terms of, how to prep a company, what to look for, just before going public, readiness, etc. Right? I think there's a lot that we can do in terms of
building that ecosystem around and getting that interest in here. All right. I think we have a little funny question for you, Satya. How do you retain employees after they have now become wealthy? if you want to take that.
The joke is that they'll become wealthy, but no. So there is always a challenge. I think even in private markets or public markets, I think retaining good talent is always a challenge. But I would probably want to think of this more as an opportunity in terms of what can we see at all points of time. There's a normal curve in terms of employees that are part of the team, right? So people who are ambitious, who really want to do well, you always keep them one step ahead. At least that's what we've tried to do, right? Always give them a higher opportunity. I always give them a higher responsibility, right? So I think that phenomenon continues either in private markets or public markets. So I don't think anything changes from an employee engagement point of view. Just always keep giving them one level higher in terms of challenge. So that they're always learning, they always feel part of the team, they always see value in the work that they're doing. I think that principle is there across.
Yeah, so there's no different color to drive an ambition, whether you are private or public, right? That's the takeaway.
Absolutely.
Wonderful. So I think that we've had a lot of discussion, and with that, I think we are coming to wrap up this discussion. So I want to take a moment to thank you sincerely, all of you. I think those were very insightful views. Generally we don't get to see such a comprehensive view around this topic. So thank you so much, and thank you to audience as well. I mean, it has been a great engagement, and hope you got insights out of this discussion. With that, I think we won't stand between lunch and you. We are a little over time, so I think. Let's continue these discussions as part of lunch, and we look forward to seeing you for the other panels as well and other discussions. Thank you so much.
Thank you. Thank you.
insightful, engaging, and packed with real life learnings. Thank you, speakers and moderator, for such a insightful deep dive into the IPO landscape. I now request our moderator, Mandar, to please present a small token of gratitude to our panelists.